Picture two friends, same job, same paycheck, same Friday night takeout. One of them starts investing in his 20s, $300 a month, into an index fund for exactly 10 years. Then he stops. He never puts in another dollar after that. The other one waits. He starts in his 30s and he keeps putting in $300 a month for the next 20 years straight, all the way to retirement. So who put in more money? The second guy, obviously. He put in almost twice as much. But when they both retire and check their accounts, the first guy is ahead. Not by a little, by a lot. That sounds impossible, but it is exactly what happens. And by the end of this video, you are going to understand exactly why and exactly what you need to do about it today. Why should you watch this video? Because if you solve this one problem right now, the problem of not knowing where to put your money, you end up 10 or 20 years from now being the person other people look at and say, wow, they actually figured it out. If you do not solve it, you will still be saying the same thing you are saying today. I probably should start investing. And that gap, that stretch of time you lose, you can never buy it back with money. My name is Moon. I obsess over where money moves and who is actually moving it. If you have ever felt stuck, like you know you should invest but have no idea where to start, or you bought some stock, it dropped, and now you are just frozen holding it, hit subscribe. And if this helps you, tap that like button. It genuinely helps. Where does the money go? Who actually wins this game? And what should you do starting today? We are covering all three right now. Let me give you the conclusion first. Someone who picks one hot stock and swings for a home run will, almost always, lose to someone who quietly puts money into the broad market, consistently, for a long time. And the reason that is true comes down to one word: compounding. Compounding is the only kind of magic where time itself turns into money, and it gets stronger the earlier you start and the longer you stay in. Let us break this down, piece by piece. Simple enough that a 12-year-old could follow it. Here is a myth a lot of people believe. They think the people who got rich from stocks did it by picking the one perfect company. Sure, that happens sometimes, but that is like interviewing lottery winners. The people who win get interviewed. The millions of people who lost money buying tickets, nobody puts them on camera. If you buy one company and that company fails, your money is gone with it. But if you buy the entire market, an index, some companies inside it fail, sure, but new ones take their place. The market as a whole has kept climbing decade after decade, as long as people keep working and economies keep growing. Over roughly the last 100 years, the broad U.S. stock market has trended upward, and historically, it has averaged something like 7 to 10% a year. That number is the key to everything in this video. Now here is where it gets genuinely fun. Let us actually run the numbers. Say you invest $300 a month into an index fund, averaging around 8% a year. After 10 years, you have put in $36,000, but compounding turns that into around $55,000. After 20 years, you have put in $72,000, exactly double. But your balance is now around $177,000. Your contributions doubled. Your result more than tripled. After 30 years, you have put in $108,000. Your balance? Around $447,000. See what happened there? Your contributions grew like simple arithmetic. Your results did not. That is compounding. Here is why. With compounding, the money your money earns starts earning money of its own. Think of rolling a snowball. At first, it barely seems to grow, but at some point, every single roll adds a noticeably bigger layer. Compounding works exactly the same way. The first 5 or 10 years feel like almost nothing is happening. And then, somewhere around year 15 or 20, the line on the chart suddenly bends upward, hard. Now go back to those two friends. The one who started early bought himself 20, 30 years of that snowball rolling. The one who started late put in more cash overall, but he lost that same stretch of rolling time. And that is the one thing you can never buy back, time. At this point, you are probably thinking, okay, but if I just pick a stock that beats 8%, wouldn't I get rich faster? In theory, sure. But here is where the psychology wrecks people. When you own one stock, the price can swing 10% in a day off a single headline. And what does that do to a person? And when it goes up, you think it will keep going up, so you buy more near the top. When it drops, you panic and sell near the bottom. People do this over and over, and the result is that most individual investors end up earning far less than the market average, not because the math failed them, but because their emotions did. An index fund does not do that to you the same way, because it is not one company, it is the entire market, so the swings are much smaller. And if you genuinely believe the market trends upward over the long run, you can hold through the dips instead of selling. That ability to just hold on matters more than the return rate itself. Because compounding only works if you never fully cash out along the way. Sell everything once and your snowball starts over from zero. So index investing is not the lazy option. It is actually the smart one because it protects you from the single biggest risk in investing, which is your own emotions. Let me tell you a quick story. Two people, same age, 25, started at the same company on the same day. One of them chased hot tips. Some months he was up 30% and felt like a genius. Other months his account was cut in half, and he could not sleep. 5 years later, he ran the numbers, and he was basically back where he started, except for all the stress. The other one just set up an automatic transfer, $300 straight into an index fund every payday, and then stopped checking. 5 years later, his balance was meaningfully higher than what he put in. And more importantly, he did not lose a single night of sleep over it. Stretch that out to 10, 20 years, and the gap gets enormous because one of them kept rolling the snowball and the other kept smashing his and starting over. Right now you might be thinking, isn't it too late to start? Or, isn't the market too expensive right now? Honestly, people have felt that way at every point in history. 10 years ago, 20 years ago, same feeling. But the real lesson from those numbers is that what matters is not the exact percentage you earn, it is how long your money stays invested. So waiting a year or two for the perfect moment costs you more than just starting now, even if prices feel a little high. You might also think, I do not have much money, but does this even matter for me? It does. Remember the example, $300 a month, not a huge number. What matters is not the size of the check. It is how much time you buy yourself by starting today. So here is what you actually do. Starting now, open a brokerage account if you do not already have one. That first step is the hardest part, so just get it done today. Choose a broad index fund, the whole market, not a single company. Set up an automatic transfer on payday for whatever amount you can manage. It does not need to be large. And then stop checking the price every day. That is genuinely the hardest part, and it is also the most important one. 4 steps. That is it. And if you are watching this and you have kids, here is something I really want you to do. Take everything you just heard, the snowball, the 2 friends, and explain it to your kid tonight. You do not need a single technical term. 1 sentence is enough. Start early, stay in long, and you win. If a kid understands that sentence before they turn 20, they start their entire financial life ahead of almost everyone else. That is worth more than any amount of money you could hand them directly. So let us wrap this up. The reason to invest in stocks is simple. It is the only realistic way for your money to start making money on its own. Chasing one hot stock looks exciting, but it usually ends with your emotions wrecking your own results. Steadily putting money into the broad market for a long time quietly wins. It is not flashy, but it is real. Start with 1 account today. That small action is going to look completely different 10, 20 years from now. Protect and grow what you have built. If this helped you, subscribe and hit like. And if you know someone who keeps saying they should start investing but never does, send them this video. See you in the next one.